Good afternoon, everybody, and welcome to this edition of our weekly market analysis session. My name is Carl Capolingo. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be with you as we wrap up all the key moves in markets from last week and look to the week ahead. Now, there were a bunch of key moves. Certainly in crypto, kicking off, you can see sweeping declines across the board there. As much as 20% for Avalanche, not far off for chains like Polkadot, Ethereum, one of the majors, down 17%, and Bitcoin, the biggest of the lot there, not far behind on at 13%. Now, this is a Saturday to Saturday comparison, so perfectly valid in its own right, but we have seen a bit of a rally in Sunday's candle and a little bit into Monday morning, order of magnitude 2 to 3%, so relatively small bounce back compared to last week's thrashing. Fear and greed index down to 27. That's 20 points lower than where it was last week. And last week it was at neutral, indicating some confidence returning to this market after 6 consecutive weeks of gains, as can be seen on screen. So I'm talking about these 6 candles in a row here, which took the total market capitalization of the crypto universe. Well, let's just recap the fall from 3 trillion first down to under 8 trillion, but took us back from that 8 trillion closing in on the 1.2 trillion mark. Now we're back to about the 1 trillion level from that decline, as we can see. And if this was anything else, if it was anything else but crypto, you would look at it clinically and say that this downtrend is now well established. Short-term downtrend is well established. The long-term trend is breaking. Potentially the test of that long-term trend zone has failed quite miserably, and we are coming down for lower and lower prices, certainly at least a retest of that intermediate low there. Not looking good at crypto. What went wrong? Well, eventually a few things, mainly to do with a broader risk-off move in markets. We'll talk about that in a second. A rise in long-term, well, actually both short and long-term interest rates, stoking that risk-off sentiment. There was some talk also of potential liquidations in the Bored Ape Yacht Club NFT space as well. And look, order of magnitude, small tens of millions, not hundreds of millions. So whilst not fantastic to talk of another liquidation in crypto space, relatively small compared to the daily turnovers of, say, Bitcoin or Ethereum. So I don't really think it was that. I think it was more to do with this broader risk-off sentiment. We can see on screen the Bitcoin chart did challenge that 25,366 I've been talking about many times in these sessions, and I have said to you, we need to see a close above that level, not just a tickle of that level. And I say that because supply is never finite at a particular potential supply point. It is spongy. Some traders get a little bit late to the party, and maybe we're a little bit above 25,366 in a session, and that's when they start to come to sell. Often they'll wait for stops to be run above that level from the short side before they then engage new short positions, and certainly bring supply to the market that could turn the tide back to the supply side. So we didn't see the close above that. Good reason not to get too excited, and you wouldn't be too excited by the current price action as we plumb back towards the big handle there at 20,000. But more importantly, I think this supply zone here between about 18,608 and 17,585. If we close beneath 17,585, we are 100% still in this bear market trend, and we will head even lower. 13 or 13.8 I think is the next key level. That's a 2017 high point, but don't quote me on that one. The Ethereum chart looks better in that there was a better trend before it got belted, but it still got belted. 15,559 still holding at the time of me recording this, but a close beneath that would see us test, I believe, 13,56, and a failing of that close beneath would see us test somewhere around that 996 to 880 level, which unfortunately, the reason why I'm talking about that first rather than the upside, is probably the most likely scenario with this big black candle slashing through what otherwise was a nice short-term trend rally here. Fingers crossed something can happen here at 15.59. We get a bunch of white candles coming in response very quickly to give us a hold of that short-term ribbon there, and maybe another test of the long-term downtrend zone, which is firmly fixed. Now you can see the static supply coming in between 2016 and 2031, but again, this massive dynamic zone that, at the end of the day, it was always going to be the elephant in the room sitting on that Ethereum price, and the weight of that elephant has reasserted itself on price action. So unfortunately, as optimistically bullish as I was on Ethereum previously, I think I'm going to have to go back to more of a neutral bias there, if anything, a slightly bearish bias. Interestingly, a little bit of a bearish bias creeping into stocks, starting off in the Asian region. The Nikkei still managed to gain for the week, but Shanghai and the Hang Seng are down, mainly on China economic growth concerns. The US economy also catching some of those, or catching a bit of a cold from some of those concerns, but mainly on the back of a rocket emoji print on German wholesale inflation. You might think that is just so obscure and has no bearing or significance on a global, stock markets, but it was just such an amazing print that it got markets worried, and we'll learn more about that as we go on. European markets down, not surprisingly there on that print, the German DAX underperforming. Having said all of these negative bits and bobs creeping into thinking for equities investors, volatility has been on a very consistent decline now for, if I counted those candles, I'll probably get into double digits. So we shouldn't necessarily then look at 1 week's move in isolation and say, well, that is the top, that is it, and we're coming back down from here. Let's have a look at the S&P 500, try to throw some more light on this idea of, is that the top? Is this the bear market rally? It's done, it's dusted. Didn't quite get to that 20% psychological level to swing us back into a bull market, and down we come again. I'd have to say no. Just looking at the basic technicals here that are telling me demand is still very much in control at this point. Yes, that is a blip. That Friday candle, that big black smudge there, certainly telling us that supply has arrived, but I would say the balance still needs to be skewed, or the balance between demand and supply is still skewed towards the demand side. Short-term trend is still up, it's still well established. We actually did crack above that long-term downtrend zone. It's starting to change colour now. You can see there through my traffic light system going back to orange. And really, if we can hold here with some nice white candles and some long lower shadows into 4,200 down to maybe 4,168, it is going to set up nicely for a continued rally. This is an important zone though. If we slip back beneath that long-term trend zone, if we slip back beneath the short-term trend zone, which continues to appreciate, I think we are starting to be in a bit of trouble. I wouldn't get, I wouldn't turn completely bearish until we cracked, say, beneath 40.79 on a closing basis. I think if we got beneath there, then we are turning the tide. But happy to give this rally, which is just, punctuated by so many white candles, so much by the dip activity, FOMO activity, that you have to give it the benefit of the doubt. Above 43.26, it's it's all happy days and we're off to the races. Looking at the NASDAQ, a far more risk-on market, and we can see the difference between the blue chips here at the S&P 500, obviously clearing that long-term downtrend zone, and the NASDAQ really still dealing with it, hasn't exactly cleared it. In fact, pushing back towards the bottom end of that range. Just give you quick key levels here: 13,181, a close above that, and all is happy, all is good. We'll look at 13,711, mirroring, I guess, some of those downside support zones there, the light green zone, the short-term uptrend ribbon. Probably looking at a close beneath 12,320 to say we've closed beneath that. And yeah, again, starting to get a little bit concerned there. I think beneath 12,093, then this uptrend rally is over. Having a look at some of the commodities now, and this is again sort of queuing off that weaker China growth, weaker global growth concerns. You can see unanimously down there. A couple of interesting points though. Copper missing out on the declines. That's interesting. Key industrial metal. But the other key industrial metal, iron ore, getting absolutely shellacked. down over 8% both in the Chinese yuan price out of Shanghai and the US dollar denominated contract there in Singapore. That's the one that's on screen now, and you can see a definite, well-established skew to the downside there in the short term, and growing in terms of the long-term trend with to this 84.60 now the key target to the downside. Didn't get a look at it last time, stopped at 95.50. Be interesting to see what happens if we do get there. Having a look at the coking coal futures now. It's a new chart I'm showing you. Haven't put this one in before, but it does gel well with the previous chart of iron ore, because obviously you take the iron ore and coking coal, put them together in a big blast furnace to create the steel that is then used in construction globally, but more specifically with respect to Chinese infrastructure, increase in spending that the government has planned there, and also the real estate sector, which we know is struggling. So we have seen a little bit of a bounce on the back of some increased rhetoric from the Chinese government in terms of their efforts to stimulate construction. But we can also see that the long-term trend is turning, almost now well established to the downside through the contraction here in this long-term ribbon, potentially going to change to the dark pink there. However, maybe there's a little bit of upside momentum potentially to 300 before we see some renewed weakness. Bottom line is, if we're talking about growth-oriented commodities, here's copper, the trends are more skewed to the downside, I would suggest, despite the fact maybe there's a little bit of a short-term rally going on in some of them. There's nickel as well, another key industrial metal. Not an industrial metal, but one we do cover regularly is gold, and we can see not a whole lot going on from the initial bar there on the far left to the last bar on the far right. But I would suggest to you this one is also weakening, with this long-term downtrend now becoming more established. This area here, sort of just above the 18 handle, I think now well established as supply, looking at these upper shadows and quite aggressive black candles coming from there. I can't see any reason why we couldn't target 1680 in the near term. This is a massive, massive level, because beneath that we will head, I believe, to $1,500 an ounce. Having a look at some of the energy and currency markets here, we can see a softer week for crude oil, again in line with that growth story, or weakening thereof, down 2.3% on West Texas, 2.1 on Brent. Natural gas, however, bucking that trend, up 5.84, and this is where I'm going to draw a line in the sand here between your industrial growth type commodities and your I'm going to call them keep warm commodities from here, because natural gas is very much in that basket of keeping warm and keeping the lights on, so our kids can continue to play video games and do TikToks. But also to keep the air conditioners going in August over there, but the not too distant future, potentially keeping the Europeans warm in winter as well. I think this is the looming threat. We talked about an elephant in the room earlier on with respect to Bitcoin, but I think this is the big elephant in the room that investors are now starting to position themselves for. The Australian dollar down a massive, to be fair, for a currency in a week, 3.5%. On the back of those weaker commodity and growth concerns, as the US dollar, King dollar, rallied. It is a defensive asset. And we saw both Australian and US bond yields on the rise there, 8 basis points for the Aussies and 13 basis points, substantial gain for the week for the US bonds, 10-year bonds. We'll talk about those a little bit more in a second, but I did want to just expand on this idea of what I call these keep warm commodities. Now, this one is natural gas. We do have a natural gas CFD contract on the ThinkMarkets platform, which you can trade. And I challenge you to go and look that up. If you don't have an account with us, that's the other thing you need to get sorted out. But if this was anything else, and if you're a stock trader, an Aussie stock trader, and you're used to looking at BHP or Rio or any of the big four banks, if it was any of those stocks, you'd be looking to buy, because we have just the most amazing trend. And if anything, the trend is accelerating. Incredible white candles over the last couple of weeks as well, indicating lots of buy the dip, lots of FOMO in this market. And if we were to close above that sort of 950 level, we really are off to the races here. It's pretty much blue sky from there. So certainly sounding the alarm here on this natural gas potential trade. The other thing I think you need to note, and this is the this is US natural gas traded on the NYMEX exchange, is that we're actually seeing volumes decline as price go up. And a lot of times people go, oh, okay, well, I'm not going to put a lot of faith in this rally because we've got increasing prices on lower volume, and that is a completely erroneous way of thinking. What's actually happening is that producers are struggling to increase their supply even in the face of rising prices, and this is because we have massive supply constraints at the moment due to the pandemic, and prices going up because of that lack of supply. So that low volume is just reinforcing this supply side blockage as demand is building in the face of this pending European winter. If only just to reinforce everything I've said, this is the price, the Dutch price there. Obviously, the more European-specific contracts. So we're seeing this one priced in terms of euros. Very similar, of course, but you can see it has taken out that intermediate high there at 225, let's call it, and it is a vertical line straight up at this point in time. Natural gas companies on the ASX, Woodside is really the major one there, and there's daylight between them and the next one. Santos does have some natural gas production and exports, but largely its production is retained for use here in Australia. So Woodside is the key exporter there, and therefore the potential key beneficiary. This is a coal price chart, because if you can't acquire natural gas to power your power stations, because that's the natural gas has always been seen as the go-to, that stopgap solution between us and our renewable energy future. If you can't get it, then you have to burn this dirty, wonderful, whatever you want to call it, coal. And this is Newcastle thermal coal prices. So this is a price that Australian coal producers like Whitehaven, ticker code WHC, Terracom, ticker code TER, although Terracom does have some coking coal exposure, and NewHope coal as well. The key local place for thermal coal, here look at the thermal coal chart, bashing up against those highs around 446 from just after the Russian invasion of Ukraine. And once again, if this was a stock chart or any other chart, mind you, you would be buying it with your ears pinned back. So certainly, again, sounding this one out as a potential opportunity. Bringing it back to what we normally talk about in these sessions, just looking at the yields there, and we did see them push back up, and they have been pushing back up for a couple of weeks now, and maybe a little bit more evident there on the US yields pushing back towards 3%. On this huge print we saw in the German Producer Price Index, which is coming up, I'm pretty sure, on the next slide. I'm just showing you the yield curve here, and it's the orange line is the current one. That's the one you need to watch out for. And what we're seeing here from last week, you can see just a huge bump up across the board. So both short-term and longer-term rates rising, and we've still got this inversion of this yield curve, which is a very strong predictor of lower global growth ahead, indeed of recessions. So it's a very high correlation. This inversion for predicting recessions down the track. But rates on the way up. This is that number I keep banging on about today, and this is why I'm banging on about it. So this is the 1970s oil crisis, and we probably, if you had anything to do with economics, over the last 50 years, you certainly would have learnt about this one. I know I did when I did my economics degree back in the 90s. And here we are now. So this is something that was unprecedented at the time, historically significant, and for so many years never got anywhere near there. And yet here we have the COVID pandemic creating a scenario where we are just going absolutely into the stratosphere in terms of wholesale prices in Germany. Now, this is obviously B2B sort of prices. Once we get to the consumer, this is going to flow through. This 5.3% month-on-month gain for July. Now, CPIs around the world are somewhere between sort of 6 and maybe 9% year on year. We just logged a 5.3% month-on-month gain in Germany. I know it's pretty specific, but Germany is the largest economy in Europe. And some of it will be exported around the world as well. And because of the causes here, energy price rises far more acute in Europe than we're feeling here in Australia or in Asia or in the US, and continued supply chain disruptions. The situation I say here is dire in Europe as energy security builds as a major looming issue. So this is important. 37.2% year on year is the stat I didn't give you. Very quickly here now on the Chinese stuff, because I'm just looking at my timer. We're already over time. So just mentioning that we saw some weaker data on the Chinese economy. No surprises there. Wasn't significantly weaker. So just mentioning it in passing. Down on fixed asset investment, lower than expected, lower than the previous. Industrial production, lower than expected, lower than the previous. The retail sales, much lower than expected, lower than previous, but the unemployment rate ticking down. I didn't read up on that one, to be honest, but maybe something to do with the participation rate there. I don't think it's strengthened the Chinese economy. Reflecting the weakness in China's economy is growing weakness in the US economy, particularly in the home building side of things. A major employer in the US and a major source of US GDP. And I did sound this out last month when I talked about the plunge in the National Association of Home Builders Index, a very forward-looking index surveying home builders. How are they feeling about things? And we're now into contraction here officially for the industry at 49, below that key 50 level, and coming off some massive highs there. But it's the pace of a descent which I would call to your attention. And we're seeing permits and starts also beginning, I would suggest you dropping off the cliff, and that phrase has been used many times. Will the central bankers drive the US economy off the cliff, take the rest of the world with us in their unrelenting, it seems now, or at least markets are believing that way, fight against inflation? Well, we got the Fed meeting minutes from July where they did raise interest rates for the second time by 75 basis points. Participants judging that a significant risk is still elevated inflation, and it could become, quote unquote, entrenched if the public begin to question the committee's resolve. It would be likely appropriate to slow the pace at some point, but that pace is not going to be slowed anytime soon, potentially. And you can see there it would be appropriate to maintain a sufficiently restrictive level for some time to ensure that inflation was firmly on the path back to 2%. So we're going to slow potentially, but we're also potentially going to retain, even after we slow, we're going to retain interest rates at an elevated level for a persistent period of time. So we've got slower growth and higher rates. We'll get more info at the Jackson Hole Symposium this weekend, where central bankers get together to chat about things. It will be very interesting. Bring it back home, looking at the Australian employment data, which wasn't good either. So we've got just continuous bad news here on economic growth. The economy lost 40,000 jobs, mainly in full-time jobs. That's even worse. And don't be fooled by this falling unemployment rate down to, was a 50-year low there at 3.4%. It was because we saw a significant drop in the participation rate. So fewer people being able to get out there and look for work. Let's have a look at Aussie equities now. For me, I look at this 1 month column, this plus column here. I don't get it. Maybe somebody can explain it to me how we have done so well, particularly the materials sector. And then I think about things like a huge, cash profits being declared by your BHPs, your Rios, and big dividends coming from some of those, and maybe Aussie investors and their this overriding love of dividends and franking credits maybe clouding their judgment as to what the trends are in what these guys are selling. And yes, those profits are magical and wonderful, but they're based upon historical commodity prices, and I've just laid it out for you that most of the trends in commodity prices are down. So a little bit baffling for me, I must admit, a little bit biased in my opinion, because I was calling them lower and I've been proven wrong by the market, and all that matters is what the market thinks. Another 3.4% gain for the materials sector last week. And then you've got financials up 3.7%. So I'm just pointing out where the big index points are for the last month to stoke this rally. Energy contributing as well. The thing about financials, of course, is investors have bought those stocks up significantly on the back of this very short-term boost in interest rates we've had locally, as we've had lift-off on the official rate, and the bank's ability to hold back on increases in what they pay us in term deposits compared to what they're charging us on mortgages, and they're going to earn a nice little super profit in the meantime, again, potentially juicing their dividends. So I don't know really what Australian investors are thinking, and it's, as I said, the market's always right, but here we are, not at 64.7, we're at 71.38. We've also seen, obviously, the US markets contribute a great deal to that. But on this point of the narrowness of the rally and the influence on index points on just a few majors, have a look at the likes of, say, Apple, Amazon and Tesla, which have rallied very strongly there, whacking on significant index points in the USA as well. So are all stocks created with the quality that Apple and Amazon have? No, I'd put to you they're not. And therefore, if much of your rally, much of your points is coming in just a few stocks, that I think should concern you a little bit. Nice little segue into this to prove my point a little bit, in that we're talking the technical analysis market breadth for the ASX 300. So where are stocks trading with respect to their 5, 10, 21 and so on moving averages? So, are they trading above their trends or below their trends? So if we look at the 11th of August, which wasn't quite the highest point in the chart, but certainly the highest point, I believe, in enthusiasm, we can see that, over 80% of stocks were trading above 2-week trends, and we had more than two-thirds of stocks trading above well over 2/3 above 1 month trends, and probably 60% above 3-month trends. And then we get to Friday's close, and we'd see how much deterioration occurred last week. Last week, there wasn't a lot of movement in index points. In fact, we're up 1.7%, but that gain occurred on fewer and fewer stocks participating in the rally. Make of that what you will. Hasn't come out too much on the trends yet. We did see the gold stocks move back to downtrend, utilities to neutral, but otherwise most of those sectors still holding short-term uptrends. It's a more mixed picture in terms of long-term trends. Energy still the key sector there. It's the standout, but again, less enthusiastic about those growth-oriented crude oil-focused companies, and more interested in the natural gas and thermal coal plays. I've mentioned a few earlier in this session. Is there value in the market? Well, it's not terrible. I mean, we typically say that 15 is fair value for the index. 20 we would say is expensive, and coincidence, 20 was the post-COVID peak at the previous highs. How about that? And we say about 10 is what we'd call cheap. We got down about 12.9 a couple of months ago, or just about 6 weeks ago. So you can see from that 12.9 we're moving with the increase in the market, and also potentially earnings season coming out, and therefore some earnings downgrades from brokers. You can see this PE rising closer to that 15. In terms of sectors that are still maybe on the cheaper side, or discretionary, still certainly at the bottom end of its post-COVID range. Energy looking very cheap, but be careful with that one, and materials, because they are cycling an earnings bump. However, get the right one. Earnings are probably going to stay higher for, or stronger for longer. I'm not so sure for the materials sector. Financials probably getting more towards a fair value sort of range. Healthcare, I think, has also had a decent move up as well. That's mainly CSL. Information technology still certainly towards the bottom end of its range there, and well, if it's high at 77. Property still looking cheap if you're of that persuasion. Staples getting more back towards fair value, you'd say. Telecoms probably on the wrong side of fair value. I'd put to you getting close to expensive. That's mainly your Telstra there, and utilities still looking actually very cheap, below their pre-COVID levels. Having a look ahead to the data coming out this week, we've got the manufacturing and services PMIs coming out. So that's Purchasing Managers Index is what PMI stands for. And then obviously the Jackson Hole Symposium coming up later in the week or on the weekend, obviously reflected here on the international markets as well. We'll get the PMIs for Europe, US coming out Tuesday night. Then some big numbers there. Core durable goods orders in the US Wednesday, followed by the GDP numbers. Markets will be watching that very closely because we obviously waiting on another quarter potentially here of negative US economic growth, and then the core PCE price index, which is the Fed's preferred measure of inflation, will be interesting in light of that German PPI number, and that is accompanied by personal income and spending numbers also. Hey, if you'd like me to look at your portfolio, well, just come along tomorrow. Ask the experts, Tuesdays, 1 p.m. Bring your stocks and I'll give you my best technical and fundamental reader on those. You do need to register though. There's the link. If you're not a client of ThinkMarkets, well, you should be. We have all the products you need to trade, including products like natural gas. Trade that alongside your thermal coal shares. So certainly call your customer service representative and ask them for further details. Otherwise, we do have a great rate on our CHESS sponsored trades, certainly a lot cheaper than what you're paying with your big banks. Head to thinkmarkets.com/au for more information. If you're watching on YouTube, hit the subscribe button to stay notified of any of our future videos, and hit the like button to let me know you like what I'm doing, so I'll continue to do it. Apart from that, it has been a pleasure chatting with you today. All the best for your trading and investing. Till we catch up again. Bye-bye for now.